Hello everyone. This is in continuation to our topic marginal costing. This is third part. Question 3. A company has 3 factories situated in the north, east and south with its head office in Mumbai. The management has received the following summary report on the operations of each factory for a period. So here they had given us sales actual and what was budgeted. And they didn't give us what was budgeted, but instead they gave how much is over budgeted, how much is under budgeted. Whatever is inside brackets, it is under budgeted. And profit, they gave us same thing, actual and over or under budget. For all the 3 regions, north, east, south. Calculate for each factory and for the company for the period, the fixed cost, the break-even sales. So here, if we look into the under budget or over budget, whatever it is actually, you may understand it is a change in sales. It is actually change in sales. So we can say this one is change in sales. This one is change in the profit. So when we have change in sales and change in profit, we can very well calculate the PV ratio for all the 3 regions, north, east, and south. We can calculate the PV ratio, and that will be change in profit divided by change in sales multiplied by 100. So first one for north, it will be change in profit, which is 180 divided by 400 multiplied by 100. We will get 45%. Similarly, this one is 90 divided by 150 multiplied by 100. That will give us 60%. Third one, 110 divided by 200 multiplied by 100. That will give us 55%. Now, we know sales is equal to fixed cost plus profit divided by PV ratio, which means we can say fixed cost is sales multiplied by PV ratio minus profit. Minus profit, which means for north, east, and the south, we can calculate the fixed cost. Sales, which is sales is given here, 1100 into 45%, so 0.45 minus the profit. Profit is 135. So if we calculate that, we will get 360. The next one, 1450 into 60% minus profit is 210. So that will give us 660. Then for south, 1200 into 0.55. 0.55 minus profit, which is 330. That will give us 330. If we add, we will get the total for the company as 360 plus 660 plus 330. We will get 1370. That will be the total fixed cost. Now the next one is this is actually what we have done is first part. Now the second part is break-even sales. We know break-even sales is fixed cost divided by PV ratio. So here north, east, south. First one will be 360 divided by PV ratio, which is 0.45. That will give us the sale as 800. Then 660 divided by 0.6. That will give us 1100. Third one, 330 divided by 0.55. That will give us 600, which means the total for the company, it will be 2500. That will be the solution for this question. Let us move on to the next question. PQR Limited has furnished the following data for 2 years. Sales PV ratio and margin of safety as a percentage of total sales are given for both the years 2021-22, 2022-23. Sales here it is given as 8 lakhs, 50% is the PV ratio, MOS is 40%. Here we need to find out the sales for 2022-23. PV ratio is given as 37.5% and MOS as a percentage of total sales is given as 21.875%. There has been substantial savings in the fixed cost in the year 2022-23 due to the restructuring process. The company could maintain its sales quantity level of 2021-22 in 2022-23 by reducing selling price. You are required to calculate the following sales for the year 2022-23 in rupees, which is asked here as a question mark. Then break-even sales for 2022-23 in rupees, fixed cost for 2022-23. So these are the three things asked. Now let's start. In 2021-22, PV ratio is given as 50%, which means variable cost ratio should be 100% minus 50%, which is 50%. This 50% is PV ratio. Okay. Therefore, variable cost in 2021-22 will be rupees 8 lakhs times 50%. So that will give us, what is that 8 lakhs? It is the sales what is already given, rupees 4 lakhs. Then in 2022-23, sales quantity has not changed. Means even the variable cost won't change in that case. Thus, variable cost in 2022-23 will be rupees 4 lakhs only. Then In 2022-23, PV ratio is given as what? 37.5%, which means variable cost ratio will be 100% minus PV ratio, which is 37.5%. That will give you 62.5%. So when we have this variable cost ratio as 62.5%, then our sales, thus sales in 2022-23 will be variable cost, which is 4 lakhs, divided by the variable cost ratio, 62.5%. If we calculate that, we will get the sales as 6 lakhs 40,000. Then in 2022-23, break-even sales is equal to 100% minus margin of safety in percentage, which is 100% minus 20, what is that? Given 21.875%. So that will give us 78.125%, which means our second question, break-even sales will be 6,40,000 multiplied by 0.78125. If we calculate, we will get 5 lakhs as the break-even sales. Then third part, we have to find out fixed cost. Fixed cost is nothing but break-even sales multiplied by PV ratio for that year, which is 5 lakhs multiplied by 37.5%. So it is 0.375. If we calculate, we will get rupees 187,500. That is the solution for this particular question.